How we're going to walk through exercise 410, preparing, adjusting, and closing entries for a merchandiser. The following list includes selected permanent accounts and all of the temporary accounts from the December 31st, 2017 unadjusted trial balance of Emeco Company. Use these account balances along with the additional information to journalize adjusting entries and closing entries. Emeco uses a perpetual inventory system. So you can see we have the accounts listed and their balances if they're debit or credit. Here's the additional information. Accrued sales salaries amounted to $1,700. So we have incurred some sales salary expense. Since it is incurred, we need to record it, even if it's been paid or not. So our first adjusting journal entry is to debit sales salaries expense and to credit salaries payable. And you note that it's going to be the last day of the month, or in this case, December 31st. Prepaid selling expenses of $3,000 have expired. So we have prepaid selling expenses, which is an asset, of $5,600. These are selling expenses that we paid in advance of incurring these expenses. So at the end of December, we have determined that 3,000 of these expenses have expired, so we need to record the expense. That journal entry is going to be to debit selling expenses and to credit the asset prepaid selling expenses. The next information, a physical count of year-end merchandise inventory, shows 28,700 of goods still available. So we're going to look at our merchandise inventory account. We have $30,000 on our balance sheet in our accounts. And when we counted them, we only had 28,700. So the difference, 1,300, needs to be recorded to expense. That journal entry is going to be to debit cost of goods sold, so it's increasing our expenses, and to decrease merchandise inventory, the asset, by crediting it for $1,300. Next, we're going to do our 4 closing entries. And here they are. Remember, we have 4 closing entries, and they're always done in this order. So we're going to close out sales. We're going to close out our expenses. We're going to close income summary, and then we're going to close our dividends. So all of these accounts that we are closing are considered temporary accounts. We're going to close them, we're going to zero them out, so we begin the new year with a zero balance. So we're going to look at our trial balance, and what I've done is I have made the changes on our inventory accounts to reflect the adjusted balances. So I increased cost of goods sold for the inventory shortage. I increased sales salaries expense for the amount of sales salaries expense that we have accrued. And I increased our selling expenses, the amount that came from our prepaid selling expenses. So when we do our closing entries, we're going to first identify any revenue accounts. We have one that's sales. It has a credit balance. So to close it out, we're going to debit sales and we're going to credit income summary. Next, we're going to look at our expenses. We have sales returns and allowances, sales discounts. So those are kind of like contra sales accounts, but they have debit balances. So we're going to treat them as an expense for closing purposes. Cost of goods sold, sales salaries expense, utilities expense, selling expenses, and administrative expenses. All of these have debit balances. So to close them out, to zero them out, we're going to credit these accounts right here. We're going to add them up, and the debit goes to income summary. The third closing entry is to close income summary. We can take the difference between the credit and the debit, which is $84,500, so that's $529,000 minus $444,500. We're going to debit income summary for $84,500, and we're going to credit retained earnings. So effectively, we have increased retained earnings for the net income for the period. And then the last closing entry, we're going to close out our dividends. We have dividends recorded of $33,000, and that's a debit balance. So we're going to credit dividends for $33,000, and the debit is to retained earnings. It decreases our retained earnings balance. So now we've closed the accounts, and here are the financial statements, the income statement. It's done in a multi-step format, which is the sales minus cost of goods sold gives you gross profit. And then we list other expenses of the business to come to net income. This format was introduced in Chapter 4. Or we have the single-step income statement. This is what we've done since Chapter 1, where we have net sales, then we subtract all of the expenses, including cost of goods sold, but you'll note we come to the same net income.